Welcome to the REI Diamond Interview, your source for real estate investment jewels of wisdom with Dan Breslin.
Welcome to the REI Diamond Interview number 15 with Andy Shamberg of Liberty Insurance Brokers, your source for real estate investment jewels of wisdom. I'm Dan Breslin, and on these REI Diamond Interviews, I bring you the real estate investment community's brightest minds. Today I'm here with a special guest, a friend, somebody who's been providing services to me for a number of years now, Andy Shamberg. So welcome to the show, Andy.
Thanks, Dan. Happy to be here.
Sounds good. So share a little bit about who you are and how you kind of, I believe you were a real estate guy to begin with. So maybe you could share kind of the real estate investment background, and then we'll get into the insurance stuff for people on the call so they know who we're dealing with here.
Sure. So my family has been in the business for a number of years with about 90 investment properties through the 60s and all the way up through probably the mid-1990s. And they sold everything off. I then got into the business myself early 2000 and ramped it up to approximately 15 rental properties. I've since sold those off to 3 separate investors in the last 4 or 5 years, and now I am exclusively on the insurance agency side.
What was it about the rentals, that you had made the decision to divest?
Well, I had a full-time job in corporate America at the time, and it seemed as though the investment properties were taking up a lot of my time, and I was also looking to move into the insurance business. So I saw an opportunity to both divest my portfolio and at the same time devote more of my time to the agency insurance side.
All right. So that's important for everybody to understand that. And you grew up around real estate investors and you're working with Liberty, who services guys like myself who are fix and flip investors. And I know you do a lot of rental portfolio insurance policies. So tell us about how you got started in the insurance business, Andy.
It's an interesting story. I actually, like I said a minute ago, I worked for corporate America, a company called AstraZeneca, one of the top pharmaceutical companies in the world. And about 7.5 years ago, I was called in to a meeting where myself and 1,500 of my closest friends were shown the door. So I knew very little of anything else other than, like I said, the investment side. So it just so happens that the principal at Liberty Insurance Brokers, who at the time the company was running for about 15 or 16 years, we had hooked up and we had some conversation. And since he was intrigued by my background on the investor side, he thought we should enter into some conversation on the agency insurance side. And that's how the story began. And I came to Liberty about 7.5 years ago and have never looked back. So it was an interesting transition out of pharma, but at the same time, like I said, I had enough background from my family experience along with myself to segue into the agency side.
And this is important for everybody who's listening in to the interview right now to understand. A lot of times when you're choosing different professionals to work with, real estate agents, and the insurance brokers, contractors, the list goes on. And it's important to try to, when you first get into the business, you're not really sure. You think, every insurance, I know I certainly thought that every insurance guy was kind of created equal, so I could just run down to the local nationwide office and this guy could get me all the products with particularly the right product maybe that I need. But if the person that the nationwide office doesn't understand the unique needs of the investor, like yourself, Andy, you've been in the shoes of the investor and can kind of bring the expertise. So I kind of, that's part of why we're listening in on this call so that we can identify the right mindset of an insurance broker that we should be dealing with. Would you agree with me there, Andy?
Yeah, absolutely, Dan. It's interesting because we have made a determination as the company has evolved to do more than just insure property and casualty rental properties. The company has expanded into E&O. They've expanded into personal lines. They've expanded into larger apartment buildings. The company does a significant amount of renovation coverages. We call those builder's risk, along with vacant. And we have grown the agency to approximately 30 people. I say approximately because the number's always moving. We actually just brought a new account manager in this past Monday. So obviously the sky's the limit. And what we see out there is the typical investor, and you said it best, the typical investor knocks on the Allstate door or the State Farm door or the Nationwide door. And when he walks through or she walks through the door, there's the person that answers the phone, and then there's, one or two salesmen and then a processor. So a standard office of those companies has 3-4 people. The beauty that we have is because we're so diverse, we have a whole department that just handles the mortgage requirements, when you refinance or when you just have a mortgage and you need evidence of insurance. We have another whole department that just handles endorsements when you add properties or when you delete properties because they're sold. So because we're so diverse, we're able to address the market in a lot of different areas, and we can I won't say that we can do everything for everyone, but we certainly have zoned in on the areas that we can handle, and we bring in new markets all the time. We're up to approximately 28 carriers. When we see what it is a particular prospect has in mind or needs, we can fit that into a specific category of carriers. And so it just seems as though we can answer a lot of questions and fulfill a lot of needs and requirements of a number of different investors. Hope that helps.
All right, so let's pick it apart. We'll run through a few of the clients, and we'll start with me being a fix and flip client because that's mostly the business I understand. And I want to try to address proper insurance for a fix and flip investor. And Andy, one of the most important people that should be paying attention to the insurance policy would be somebody who's loaning money to one of these projects. So I'll give you an example. When I flip a house, we have a number of private investors, which are individuals who have IRA accounts or they have just personal cash accounts, and they may lend us, we'll use a $200,000 on one property, and we're going to fix the property up. Maybe we're buying it for $135,000, and we're putting, $55,000 to $60,000 in renovation in, and with all of our, carrying the miscellaneous costs, we're roughly at $200,000 for the entire project. And I'm going to turn around and sell that property for $265,000. So let's kind of answer this question so that the person maybe listening to the call who has the $200,000 that they're loaning to me on the project, what can you tell us to make him or her feel comfortable with that $200,000 investment they've made so that they're properly covered in case, this project burns down or, some other catastrophic loss? Can we do that, Andy?
Sure, Dan. That's a great example and a great question because the one thing that I see a lot is somebody will come to me and say, Andy, I just finished a renovation project and I want to put insurance on it now that it's occupied. And I say, oh, okay, who did your insurance on the vacant/renovation? And they said, I didn't put insurance on there.
Oh, my God.
So, yes, and that's my response, Dan, all the time. It's, oh, my gosh. So, you try and educate people, but the problem is you can't get to everyone because you just don't know what's out there. I mean, I appreciate the opportunity to be a sponsor at Ring. I also am a sponsor at a number of other organizations, and you just try basically to get the word out. The word is that if you put an investment out there and you don't protect it while you're renovating it and something happens to it, your investment essentially goes up in smoke. And in your example, Dan, on a $200,000 project, and the numbers I'll give you are a guy buys it for $100 and he puts $100 into it, and he's going to now he's all in for $2, soft costs included, and he's going to sell it for $260. So what does that look like? Well, the day that they go to settlement, the investor, they should put renovation or builder's risk coverage on that. In that example, that coverage can run for 3 months, 6 months, or 1 year. I always encourage my clients to go for 1 year, even if they're going to finish it a lot quicker. And the reason I do that is because I give them the 3 scenarios. I tell them 3 months, the premium is X. 6 months, the premium is Y, and for 1 year, the premium is Z. Now, obviously, the 1 year policy premium is going to be higher, but I then take those numbers and I divide them by the number of months. So let's just do an example. If a 3-month premium is $600 and a 6-month premium is $800, a 1 year premium could be $900. So if you do the math, you're going to see on a monthly basis the cost of insurance is much cheaper to do a 1 year policy. The other beauty about what we do and what a lot of agents don't do is we prorate your refund. So if you sell that, in that example, if you do a 1 year and you sell that building in 6 months, by rights, you're going to get 6 months worth of premium refunded to you. And all of a sudden now an investor says, wow, that's really, it's almost free compared to what it would cost me for a 3 or a 6 month policy, if that makes any sense. So, and the other thing that's really critical is the liability portion. So, there's 2 parts to a policy. There's property, and that's to protect you against fire and theft and vandalism and what we call covered perils. And then there's a liability portion, and that's the other portion that can wipe people out. And if somebody's walking by and they trip and fall because you're renovating and you left your sidewalks, unattended, you left some building materials out there, and somebody slipped and fell and they really got hurt badly, the lawsuits that are being awarded, at least in the Philadelphia area, are kind of like the way you give out candy at Halloween these days. These judges are giving out awards in the 6-figure range like we've never seen before. So it is critical to spend that little bit of money in relationship to what you're spending on the building itself. Spend that little bit of money on your insurance and protect yourself as long as that project is up and running. The other thing I want to make sure that I'm very clear on is the contractor side. When you do a project and you hire contractors, it's very important that they also have insurance. And there are contractor insurance policies out there that are not very expensive in relationship to other things. Specifically, a carpenter can get a 1 year policy for $1 million of coverage for about $700 a year. And that's fine, but the key thing, and what I just want to alert any investor to, is make sure that when you get that certificate of insurance, you require those contractors, whoever you hire, to name you as a certificate holder. And the reason that you want to become a certificate holder is if that contractor decides to cancel their policy, the first person that the insurance company notifies that policy is canceled is the certificate holder. So if you have somebody on the job and everything's running fine, and all of a sudden you get a notice from the insurance carrier that Joe Smith canceled his policy, I think your next conversation is to Joe saying, Joe, what's going on here? Why would you cancel your policy? And Dan, I will tell you, I do it for a living. It happens more often than I care to share, where the contractors, they get their certificates, they hand them to the client. The client says, this looks great. And then, boom, they start the job and they say, I can't afford $700 a year, so I'm going to cancel my policy. I already have the job. The certificate's in their hands. And then something happens on the job. He does or she does something to cause something bad to occur. And guess what? That comes right back onto the property owner because the contractor doesn't have the coverage anymore, and now there's a problem. So just wanted to paint that picture that it's absolutely imperative that when you are looking to renovate a property or you're ready to buy a property, you need to reach out and make sure that you are amply covered. And amply covered means make sure that your policy includes what you pay for the property, what you are paying for renovations, and also a minimum of $1 million of liability.
And Andy, just to clear things up, so like my first or second property that I flipped, I think I may have gotten the correct insurance because people had steered me in the right direction. Namely, one of my first private investors that ever funded a project was more aware of the insurance situation because he was a real estate guy and had flipped property, so he kind of steered me in the direction of the builder's risk. But for people who've never heard of builder's risk versus a standard, was it property and casualty insurance or, standard landlord's policy, I mean, I think that we should clarify that so people know what this product is and whether they're asking for the right product when they're going to flip a house, and why not get the cheaper policy for a landlord policy, Andy?
Great point. And here's the distinct difference. There are vacant endorsements in policies. An endorsement is an add-on. It's kind of like buying a car and asking for satellite radio. Satellite radio, in this example, would be an endorsement. You can get the car without it. Well, you can get a policy without a vacant endorsement. But here's where the problem would occur. If you go out and you buy yourself a typical landlord policy, it would probably be about 30 to 45% less expensive on an annual basis than a vacant/builder's risk policy. But here's where the problem comes in. You have a claim. Somebody breaks in, steals the copper, doesn't turn off the water, and you have all kinds of problems. And the adjuster from the insurance carrier comes in, and he determines that that property is not occupied. It's vacant. And he looks at the policy, because that's what they do for a living, and he says, wait a minute, this is an occupied policy, and yet this property is under renovation. This is not a covered claim. And that's the end of that story. Fortunately, I mean, there are times when I do get calls from people saying, oh, man, tell me how much it's going to be after it's done. And I give them certainly a lower price. They say, okay, just insure it that way. And then I give them the same example I just gave you. We won't insure a property and misrepresent it to the insurance company. We'd rather, if somebody wants to push that button, they're going to push it somewhere else because they're only going to get themselves in trouble. So the point is always insure the property correctly. If the property is vacant and under renovation, builder's risk is the correct policy for you. When it's occupied policy is correct. Keep in mind that people move in and people move out all the time. There's tenants that just, they move on for whatever reason. Normally, a insurance policy has a provision of 30 to sometimes as much as 60 days where the property can stay vacant and you could insure it as occupied. But what you need to do is keep proper documentation that you have a signed lease that ends on a certain day so that if a claim occurs after that day, the insurance carrier can determine that, hey, the tenant moved out, the landlord had to paint, put some new rugs in, it took 2 weeks, and then they're going to put a new tenant in there, and during that period of time, there was a loss. That loss would be covered. So during the large renovation portion, it's absolutely imperative that the property be insured as vacant, builder's risk. Hope that helps.
Yeah, it makes sense. And then I'm going to circle back on the contractor's piece. So if I'm a guy that's running my own rehab, I guess I want to get the answer a few different ways here. So if I'm kind of like running my own rehab and I hire this guy to do some plumbing, and I hire this guy to do some painting, and then I hire the electric guy to do the service, right. Am I collecting certificates of insurance from each of these different people?
Correct. Yes. And you're also, if you want to do it right, and I would strongly suggest to do this thing right, is to get yourself a GC policy. They're a little bit more pricey than what we call an artisan or a subcontractor policy. Like I said, those carpenters, those plumbers, those electricians, those policies on an annual basis, $7, $8, maybe at most $1,000 a year. And that's with $1 million of liability coverage. As a GC, you could be looking at anywhere from, say, $2,000 up to as much as, I have one policy running right now that's about $10,000, but he runs very large projects and a lot of them, so he needs coverage. Why are they more expensive than the subcontractor policies? Because you as the GC don't have control. It's that simple. You feel you have control, but you hire these guys and they go in there and they do the job. And, granted there's L&I inspections and you're in there looking also, but they don't work directly for you. So you have to trust that they're doing the right work. And it unfortunately doesn't always work that way. So they want to make sure, the carrier, that you as the GC have a strong vested interest in the workmanship of your subs. So they're going to get some premium for that. So to recap on this piece, all the subs must have coverage. If it turns out, because in the policy, it specifically states if you hire a subcontractor, they must have insurance because the carrier, the property/liability carrier on that building, they do not cover faulty workmanship or injuries to any subs. Make sense?
Okay. So what if I'm flipping properties, and I'm running the subs myself, I want to get this GC policy and I want to collect certificates from each person. What if it now becomes easier for me as the property owner and the investor only? If I just hire a GC, Andy, do I still have to collect certificates from each of these subs, or is that now responsibility for the GC?
That is the responsibility of the GC. So obviously you need to make sure that you have in your hands the GC certificate of insurance naming you as a certificate holder. And there needs to be something, whether it's a conversation or in writing, between yourself and the GC as to the fact that at any time you could request to see those certificates from their subs. And that's your call. If you either want to, A, collect them, or B, just have the conversation and have the GC on notice that you may want to look at them at one point or another. That's an individual thing. Right now I have about 40 or 50 projects going on. I have the same conversation with my client every time. I say, I don't need to see them, but I think you need to at least have the conversation with your GC. If you're the GC, then it's a no-brainer. You get all of those certificates.
Makes sense.
The more you can protect yourself, Dan, the better off you are. And sometimes you say to yourself, well, do I really want to spend this money? Just look at the flip side. And this is where this conversation becomes very simple. Do you want to spend $2,000, $3,000 a year on a GC policy? Or do you want to roll the dice and then get a letter from the attorney suing you, or somebody suing you for $50,000 or $100,000. I mean, that to me is a pretty easy conversation and a pretty easy decision.
Yeah, when you're right, you're right. I know that much. Cool. Well, Andy, I think we touched on the fix and flip investor strategy. Are there any other little pieces you can think of for for me, the fix and flip guy that's listening on online before we shift gears and start talking about, different investors?
I did want to just touch on one thing. So there is a fix and flip client that we have. There's also another category, and that's the vacant client. And this is the other thing that's very critical. I said before, you don't want to leave yourself naked and not have coverage. Well, let's talk just for a brief moment about the investor that buys at a sheriff sale, no matter where it is. I'm sure the sheriff sales occur throughout the country. I know they're very big in Philadelphia. So let's just say that investor goes to the sheriff sale and he buys a block of shells. A shell, as we all know, is a property that's empty and pretty much everything is cleaned out of there. They might have spent $20,000, $30,000 on that shell. Why insure that shell, right? Especially you have 10 of them. And you're going to sit on those shells for a number of different reasons. A, you may be waiting to get investment money. B, you may be waiting just for yourself to have money. C, you may be waiting for permits. D, you may be waiting for the market to turn around. A lot of different variables as to why you're sitting on an empty, vacant property. So you say, why do I need to insure that? Well, it just goes back to what I said earlier. You just want to protect yourself, okay? It's key that you put these in an LLC, but at the same time, you want to at least put some insurance on them. In relationship to the other side, when you can, God forbid, be sued, the cost of insuring that building is a few $100s a year. And that gives you $1 million of coverage. Why not do it? So the investor that fixes and flips, we discussed that. This is the investor that fixes that buys and holds and doesn't do anything. And then, if that investor doesn't put coverage on his properties, he's running down that same dangerous road as somebody walks by and trips and falls. Is it bogus? Most of those cases are usually thrown out. That's a beautiful thing because I will say that the insurance carriers have some of the most skilled lawyers that I've certainly run into. So why not have that coverage and have that protection behind you? So that's a great
point, Andy. So I have a few friends, from different cities that I'm in now, and this is a form of land banking that you just described. So there's different funds and investors who just buy land and wait for development to reach that point, wait for the neighborhood to change, and people actually will invest their money in vacant properties and shells in the same land banking strategy. And that's a great point to cover that. Now, I assume that those policies, the vacant policy, is just a liability. There's no loss of structure there, or is there some other coverage on the structure, Andy?
The one thing that I stress hard is to make sure there's liability on there, because if that thing, if you pay $20,000 for it, by rights you should insure it at 1,000 square feet. You should insure it for 60, 70,000. Most people say that they're not interested because half the time they knock it down anyway. So my first line is make sure we get $1 million of liability on there. Beyond that, it's up to the investor if they feel that they want to even put any money into it. If somebody breaks in, what are they going to steal? There's nothing there. Okay, so the theft is not an issue. The water damage, usually the water's off. So what really can happen? A squatter can get in there and, maybe he's smoking crack and maybe he catches on fire and then goes down. Half the investors, at least that I talked to on those shells, say they were, again, going to knock it down anyway. So they won't typically put a lot of coverage on the building itself. Okay, and we are able to do what's called monoline coverage, and all carriers, I should say most carriers, are fine with that, meaning a monoline means they'll only cover either the building or they'll only cover the liability portion.
Got it. So let's switch gears a little bit. Let's go with, the other investor that I know you guys excel at covering and taking care of claims, and that would be portfolio rental property managers. And we could talk about single family first, and then I know you guys are doing some apartment buildings, apartment complex insurance as well, so we'll talk about that second. I'll let you kind of steer the direction of the conversation on this piece, Andy.
Sure. So we've been doing this a long time. Like I said, the company just celebrated 25 years in the business. We will do anywhere. We'll run the gamut from the investor that has one single family rental that they're just getting into the business, or even I'll back up even before that and say that we will be trusted advisors to a rookie, somebody who's just thinking about getting into the business. And the trusted advisor information is a lot of what we've already talked about, making sure that as a roadblock comes up for the investor, that they know how to leap over that, whether it's a small speed bump or a large wall. And what I'm saying is they're going to look at a property and there could be a problem with the title. There could be a problem with a water bill of $2,000. There's a lot of different things. But the one thing that we try and advise is to make sure that they are amply covered and protected in the event of a loss. So that's the one end of the spectrum. We run from that gamut up to the investor that has a portfolio of properties, whether they're single families, multifamilies, mixed use with commercial in them, all the way up to apartment buildings. There is what's called a master policy. What a master policy does is it consolidates all of your properties onto one policy. Why is that important? We're all busy, Dan. Everybody is running in a million different directions, and the last thing you want is every 2 or 3 weeks to have to renew another insurance policy with for another property because you have 20 or 30 or 40 of them. So the one master policy, you only deal with it once a year, and the policy comes up, say 30 to 45 days before the renewal date, gives you a chance to review everything and make sure everything looks right, and then it gets renewed and you move on. We also do the apartment buildings. These are, for the listeners, anywhere from a 2-unit duplex could really be construed as a apartment building, though it really isn't, up to these large buildings that have 90, 100, 200 units in them. We can, and the insurance companies can look at a particular building, a particular portfolio of buildings, and make some determinations as to, how they want to classify those and how they want to insure those. It's important to know that as you get farther outside of any particular city, the protection code is going to go up. Anything inside of a typical big metropolitan city, the protection code is going to be a number 2. A number 2 means that you are 100 feet from a fire hydrant or less and 1 mile or less from a fire department. As you go out into the suburbs and some of these more rural areas, you're going to see the protection class is going to go up. And I'm working right now with a client who just bought 10 townhouses in a row on a cul-de-sac in a little town called Coatesville, Pennsylvania, outside of King of Prussia. And that protection class is a 9. And that becomes a problem. So I caution the listeners to make sure that as they're looking at properties, that they also look at protection classes. As the number goes up, 2 things happen. The amount of insurance companies that are interested in that property gets very thin. And the second thing that happens is the premium on the carriers that are interested is much higher than a protection class 2, 3, 4, 5, somewhere in there. So again, the price may look terrific, but buyers beware when it comes to that. Can you get the building insured? Can you get it insured for a reasonable price? So do your due diligence. As you're looking at something, reach out to an expert in the insurance side and ask that person some of these questions, all right? Or at least tell them what you're interested in investing in. If you do your due diligence properly, you'll have solid numbers so that when you ultimately buy the property, there won't be any surprises. There's nothing worse than the day before you're ready to go to settlement, you say, whoops, I took care of everything but my insurance, and all of a sudden you get a rock dropped on your head because the premium is twice or more what you had first expected it to be. So does that make sense?
Yeah, I'm curious as to what would cause what other things beside the fire hydrant would cause a protection class of 9 in comparison to a 2.
A volunteer fire department would push the protection class up versus like in Philadelphia, New York, a lot of these cities, these are all salaried fire departments. When you get out, in the example I just gave, the Coatesville example, these are all volunteer fire departments. So think about it. You're far away from the fire hydrant. You're far away from the fire department, and you also are dealing with a volunteer fire department. So all these things translate into longer time to get to the property when it's on fire. And the insurance carriers look at that, and that's how they rate it.
Got it. Makes sense. Is there any other way? Can somebody go to a website, or is the best bet just to call up the insurance agent to check out on?
Sure, Dan. You can Google the property, and you can usually find out what the protection class is. You may not get it on the property itself, but if you could Google the town or the zip code, there's a good chance that you'll see the protection class in there. Like I said, you really want to be cognizant of that when you're looking at the suburbs, because anything higher than, say, a 5, all of a sudden you're going to get the attention of these insurance carriers.
Got it. So let me ask you this. You have, let's say, a newer client, or think back through a couple newer clients. Share with us, a couple of the interesting, glaring problems that you've solved for investors when they show up on your doorstep and you look over their situation. They got 10, 15 rentals, and you say, oh, man, I can't believe this, this, and this. And, give us an example of some of the problems that you've been able to solve for people, Andy.
It's a great question, Dan. There's many There's many roadblocks that we run into here. The number one thing that I've seen over the years is the conversation around claims. When I'll give you an example of a client who right now is with company X. And for whatever reason, he had a falling out with his agent, he had a falling out with the carrier, something occurred because normally people will only shop every, say, 6 or 7 years. So if somebody is coming to me and just bought a portfolio maybe a year and a half ago, something's not right, in my opinion. So the first thing I ask is, do you have any claims? And I would say 7 out of 10 times the prospect on the other line says no. And then you ask for loss runs. Loss runs are claims reports. So every insurance carrier has loss runs on every property that they insure. So if you ask for loss runs and they come over and I see, oh, here's a theft for $35,000 paid out. Here's a small fire for $40,000 paid out. Now all of a sudden you put the pieces together and you say, okay, so you're not truly shopping. You're shopping because your insurance carrier doesn't want you anymore because of the number of claims. And then all of a sudden the truth comes out. Now, is that a problem that I can solve? I can solve a lot of problems, Dan. Sometimes there's just nowhere to go, meaning there's just either too many claims, the claims are too high. It's just a series of issues. If I don't find that the person on the other line is being totally truthful with me, there's that issue. But on a converse side, if a client or a prospect says to me, you know what, Andy, I'll level with you. I had a claim. It was a wind damage, but it was storm damage. All of a sudden, that's called a CAT claim, C-A-T, or a catastrophic claim. The beauty of that claim is it doesn't count against the insured. So in that situation, I can go to the underwriters and I can have some conversation and I can kind of get that almost removed from the conversation, that claim. And then all of a sudden now I can get that person a competitive quote, get him good coverage, and get that bound and kind of make him feel as though he's getting more coverage at a more competitive price. There are agents out there, and again, I ask you, your listeners, to beware. There are agents out there that won't go to bat for you with the underwriter for a lot of different reasons. most of which I don't understand, because the underwriter can be your best friend, certainly can be your worst enemy. You want to be, me as an agent need to be straight and upfront with that underwriter. Make sure that I am giving them all the facts, but at the same time, trying to get them to help me, trying to make them understand that this claim is not a covered claim. It's not the landlord's fault. So these are some of the problem-solving situations that we get involved in. I mean, there's many, many more, but that's really the number one situation. People come to us because they have a problem, and we are problem solvers. So hopefully that makes sense. Just know that your agent can work for you and work with you to make life easy for you. And if they're not willing to do it, or you find that they're lazy, it's time to look for a new agent.
Got it. So what if we have somebody on the line, and I know, some of the more successful investors are proactive in preparing things like their credit report, their financial statement, things of that nature when they go to the banks for a refinance. Is there anything that somebody can do to kind of prepare and have, an email they can send to you as an agent, which streamlines the phone call process, et cetera? What can a proactive investor do in a relationship with the insurance broker to kind of streamline things, Andy?
The first and foremost thing is to give that agent some time. I will tell you that I'm not afforded a lot of time in most situations. That's okay, Dan, because of the size of our agency, we can move quickly. And a week doesn't go by when I don't get a phone call from the settlement table. Andy, the mortgage company's on the phone. I'm going to put you on speaker. We need this. We need that. And we can handle that. Is that ideal? Of course not. But it's something that we've grown accustomed to, and we can handle pretty easily. But I don't suggest it. So to address your question, you need to find out the requirements of the mortgage companies and get those requirements to your agent as soon as possible. And the requirements are as follows. Every mortgage company is different. Some want replacement cost. Some want to include wind and, water damage. Some want 110% of replacement cost. Some want rents included. I'm talking specifically about occupied policies, by the way. So find out upfront from your lender what their requirements are. Because if you buy a building for $100,000, okay, and the real replacement cost on that building is $200,000, and the mortgage company requires $200,000, and you tell your agent you bought the building for $100 and you want to insure it for $100 because that's what your mortgage amount is, and everything's done, and it's sent to the mortgage company the day before settlement, guess what happens? It blows up. Mortgage company won't accept it. They don't care that the mortgage amount is $100 and the policy is $100. They want replacement cost because they know that if that building burns down and it's insured for $100,000, it's grossly underinsured. It should be $200,000. So they know that the insurance company is not going to pay the correct number, and now they're out, because now they haven't satisfied the mortgage. So they want what they want, and you have got to give them what they want, or you don't get the mortgage. It's that simple, and you don't go to settlement. So real important is to ask questions and get those answers to your agent as quickly, and not as quickly, but as early in the process as you can.
Let's talk about that, the fire claim with the $100,000 mortgage. I've actually bought properties myself from sellers who had a mortgage on the property. They had a fire on the property, and then they paid off the mortgage. I'm not sure if they did that with the insurance proceeds or not, or whether they happened to have some cash to pay it off separately. But I've literally bought the burned structures, and, the people basically kept the insurance proceeds. I mean, how does that work? Is that a possibility to pay off the $100,000 mortgage and, tear the house down? I mean, what's the requirement typically for the insurance company or even the mortgage? Do they require that you rebuild and renovate that property? I mean, is there a simple answer to that, Andy, or is it pretty complex?
Well, Dan, you asked a couple different questions in there, and let me address those, and I'll go backwards rather than forward. At the very end, you mentioned something about the proceeds. So here's what happens. An insurance company will not give you, the landlord, all the money. No insurance carrier will do it. Why? Because you'll take that money and invariably you'll either buy 3 or 4 more properties, number one, and you won't do anything with that property. That's the first thing. Or you'll take that money and say, oh, you know what? I've been trying to dump this property anyway, and you'll go on vacation or whatever. I'm just giving you silly examples, but these are things that really happen. The insurance carriers know that. So they do what's called a holdback. All insurance companies hold back approximately 20% of the claim. Why? They want to make sure that you do the work and you prove to them that you paid or that you spent their money. Okay? So the process is that the damage, the claim occurs. The adjuster from the insurance company goes out and meets with you as a landlord, and you have a contractor, and the adjuster gets their numbers together. Your contractor gets their numbers together, and that's when the negotiation begins. And I'm not saying that the carrier is trying to be, or the adjuster is trying to be a lowballer. I'm just saying that he's gone by the book, and he's saying that we could replace this, 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 and this. And your contractor saying, well, wait a minute, it's going to be more than that because we have to do this, this, and this. You negotiate, you finally come to a number, and that number is $50,000 for a particular claim. What happens is they will hold back $10,000. Your contractor will do all the work. You will produce the receipts. You'll have everything in order. You'll present that to the insurance company, and they will release the holdback, and you will get all your money. So that's that portion. Let's talk about the house that burns down. Okay, there's 2 types of coverages. There's actual cash value and replacement cost, and these are distinctly different. And it's very important that you understand. A lot of people out there, investors, they want the most for the least. What do I mean by that? They want to insure the building for as much as they can, and they want the smallest premium. So they vie for the actual cash value option. That means they can insure the building for less than replacement cost. But here's where the problem occurs. The problem occurs when there's a claim. When there's a claim, you need to be at least 80% of replacement cost. So in the example of the $100,000 that I just mentioned, you buy a building for $100,000, you bought it wonderfully well, all right? You got it way under market. Market value and replacement costs are $200,000, but you bought it for $100,000. So you want to insure it for $100,000. You borrowed $100,000 from the bank. Bank doesn't ask any questions about replacement cost. They say, okay, we're good to go at $100,000. Now the building burns down. Guess what happens? You are so grossly underinsured that there's going to be depreciation / co-insurance that's going to hit you. Those 2 words that I just used, depreciation and co-insurance, they equal penalty. And penalty is bad because penalty means you're taking money out of your pocket. So the adjuster comes in there and says, Mr. Investor, you should have had this thing insured for at least 80% of replacement cost. Replacement cost was $200,000. So you should have had it insured for at least $160,000. You've only insured it for $100,000. So we're going to depreciate this claim. So on that same $50,000 claim, they could take 20% off of there, or $10,000. You take the penalty of $10,000. You take the deductible of whatever it is, and all of a sudden you thought you were going to get a check for $50,000. You got a check for $36,000 or $37,000. You got a problem. So it's very important that you make sure, again, that you talk to your agent and understand where you need to insure that building so that you don't run into this problem. Now, I'm going to give you the flip side of it, and it happens to a lot of my clients, a lot of them. They have big portfolios, 50, 100, 200, 300 properties. They have 3, 4, 5 guys on salary working for them, working all day. They say, Andy, doesn't matter. I don't care if it burns down. I'm not putting a claim in. So I want it insured for the absolute least. What I do want is $1 million of liability. I can't recover from that loss, but I can easily recover from a claim, a property claim, because I'll send 3 of my guys in. 2 weeks later, bing, bang, they're done, and the building is rebuilt. So, there's a lot of different schools of thought when it comes to claims, and there's a lot of different mindsets out there from investors. And I always ask the same question. Are you going to put in a small claim? Andy, I'm not going to put in any claim for property. I just want to make sure that if it's a total loss and the whole thing burns down, I get something for it. And that's really what goes on here. So the mortgage companies will dictate half the time, and you need to follow with them on what their requirements are. Because if you don't do it, and if it gets through settlement, and then all of a sudden there's a problem, you're going to have a bigger problem. So ask a lot of questions and get all your questions answered. Make sense?
Sure does. Sure does. So we're approaching the top of the hour here. Do you have I like to ask this question for everybody because I'm a big fan of reading books. The knowledge that I've gained from reading books has, doubled my income and doubled it at least 2 more times after that. Do you have any books maybe you read recently or in the past that you could recommend to me and my listeners, Andy?
There's a book out there from a friend of mine, Mike McLean. He wrote it a number of years ago. It's called Section 8, Beware. And it's actually, that title would make you think, well, run the other way from Section 8. But he wrote a really good book, and it gives you a lot of do's and don'ts as it relates to Section 8. If that's the type of investor that you are, if there's listeners out there that are either thinking about Section 8 or are already Section 8, I would strongly suggest that you pick up that book. It's Section 8, Buyer Beware, I believe. I read it a number of years ago, and I wasn't a Section 8 investor at the time, but I just felt intrigued to just look into it. There's some challenges in that world, along with challenges from some other student housing and senior housing and those types of things. But there's also some very positives to it. So I found that was pretty good reading. So just something to think about. Got it.
Yeah, the Section 8 Bible, was that what it was?
Yeah, pretty much. Yeah, I think it's Section 8 Beware or Buyer Beware.
Yeah, okay. Yeah, no, I also know Mike. I'm working to get him maybe to come on one of these and share some of that stuff with us.
Sure.
So do you have I want you to answer this last question for me 2 ways. First, for the investor who's just getting started, and then second, for the seasoned investor who's been around the block a few times. Do you have any final jewels of wisdom to share with our listeners, Andy?
Protect yourself. Protect. Don't do anything as it relates to real estate without coverage. Too many people are out there without coverage. And a week doesn't go by when I don't have a conversation. And I said it earlier in this call that the people that buy these properties and renovate them and then insure them when they're occupied, that's one category. But there's guys out there with 50 properties that they feel the need to self-insure. And my words of wisdom to you are protect yourself. Always insure your properties and insure them properly.
Good advice. I thought that went without saying. I'm amazed to hear you tell us that there actually are people who have no insurance on the properties. I thought that was the first thing that you had to get done.
Mm-hmm. So do I.
Yeah. How about that?
Yeah, but it just doesn't seem to be the case. And, people that have these vacant properties, they truly don't think anything's going to happen to them, so they're just not going to insure them. And they're the ones that are most exposed.
That's wild. So we have you, and I know some people may be listening to this, so for posterity's sake, I think you are coming out to the Philadelphia Ring meeting on, what was it, the September date? We have you coming on September 9th, right, Andy?
Let me just verify that. I know it's September, and I think you are correct. Yes, September 9th.
So September 9th, if anybody's interested, come on out and hear Andy elaborate on the insurance business. That's September 9th, 2015. For more information on where that event takes place and to RSVP, the event is free, thanks to our generous sponsors, including Liberty Insurance. Go to www.ringphilly.com and you'll be able to get the address and RSVP for that event. And also, so if anybody on the line wants to get some more information, just kind of use you as an expert advisor, or, potentially, people throughout the country, would they maybe even be able to write policies, or could you describe, who you might be able to help for us as you share your contact information, Andy?
Yes, we are part of a conglomerate, a company called Brown & Brown, and please feel free to go out on their website and take a look at the company. Our website is andy@trustlibertyinsurance.com, and that'll at least give you an idea of what we're all about. My license is in all 48 states. I can write business throughout the country. I would advise that if you have an interest and you want to talk, my direct line is 215-866-0075, and I'd be happy to talk to you about what your needs and try and answer your questions. And there is no obligation, obviously. So just trying to help people, make sure that people are properly advised and have the knowledge to go into an investment with their eyes wide open.
And I will include most of the contact information right in the show notes with the interview here, so if you're listening, you can check out that site. Well, thank you, Andy. I have a few pages of notes here. You shared some great information. I know I learned a lot here, and I've been in the business for quite a while, so I thank you for coming on the show, Andy.
Dan, thank you very much. I really appreciate it. It's always a pleasure, and hopefully that this was valuable to your listeners.
All right, and most importantly, thank you for listening to this episode of the REI Diamond Interview, episode 15 with Andy Shamberg, your source for real estate investment jewels of wisdom. You can sign up to receive an email update of the new weekly podcast at www.reidiamonds.com. As a bonus, when you sign up, I'll even send you my free report on wholesaling titled Wholesale Houses 101. 9 steps to buy and sell a house with no money. That website again is www.reidiamonds.com. Until next time, this is Dan Breslin signing off.
Thanks for listening to the REI Diamond Interview. To receive the REI Diamonds newsletter and interview monthly, sign up now at www.reidiamonds.com.